If you're lucky enough to be selling a house in today's market, you might be asking yourself if the tax man is going to come for you when it's all said and done. Well, maybe, maybe not. I'm going to talk about it in this video, but first do me a favor and click the like button, and don't forget to subscribe to my YouTube channel so you don't miss any upcoming videos. I work with a lot of home sellers in the Northeast Florida area, and one of the main questions I get asked when I sit down to talk with someone about selling their house is this: if they're going to have to pay capital gains taxes. And it's a valid question because home values right now are rising like crazy, and it's on everybody's mind. One of the good things about owning real estate is you can avoid paying capital gains taxes at all if you lived in your home for at least 2 of the last 5 years as your primary residence. And if you're single, you didn't profit more than $250,000. If you're married, that figure doubles to $500,000. So basically, if you paid for $400,000 for your house and you lived in it for the last 2 years and you sell it for $500,000 as a single person, you're not going to have to pay any capital gains taxes. Now, if you're selling an investment property, the whole thing changes. You will have to pay capital gains taxes on that property, but here's the deal. A lot of people think they have to pay it on the sale price. No, you have to pay it on the profit. So if you bought a house for $300,000 and then 2 years later sold it for $400,000, if you have capital gains taxes, which you probably will, you're only going to have to pay taxes on that $100,000 difference. The profit is what you have to be concerned with. Now, if you're selling an investment property or you happen to be selling a house that was your primary residence, but you didn't live there for 2 years, you're going to have to pay capital gains taxes more than likely. However, you're only going to have to pay the capital gains taxes on the profit. A lot of people think that they're going to pay capital gains on the total sales price, but you're not. It's just the profit. So if you paid $300,000 for a house and you have capital gains and you sold it for $400,000, you don't have to pay capital gains on that $100,000 difference. So keep that in mind. Plus, you get to deduct all your expenses. Now, you need to talk with your CPA before you get into all this stuff, but there are also ways that you can defer those taxes if you want. It's called a 1031 exchange, but that's a topic for another video. I hope this helped. If you have any questions, drop them down in the comment section below, and also let me know if you've ever done a 1031 exchange or you made enough profit from the sale of your house that you had to pay capital gains. That's fantastic. I would be happy if I made enough profit on my residential home that I had to pay some capital gains taxes. My name is Mike Jones, Jacksonville's Voice of Real Estate. Thank you for watching.